Chapter 3. Making Tax-Wise Personal Finance Decisions. In this chapter, viewing your finances holistically, learning from common mistakes, overcoming tax planning hurdles. Managing your personal finances involves much more than simply investing money. It includes making all the pieces of your financial life fit together. And just like designing a vacation itinerary, managing your personal finances means developing a strategy to make the best use of your limited dollars and being prepared to deal with some adversity and changes to the landscape. This chapter explains how to keep the right perspective as you plan for and make financial decisions, and I also point out some pitfalls so you can steer clear of them when making financial and tax decisions. Including taxes in your financial planning. Taxes are a large and vital piece of your financial puzzle. The following list shows some of the ways that tax issues are involved in making sound financial decisions throughout the year. Spending. The more you spend, the more taxes you'll pay for taxed purchases and for being less able to take advantage of the many benefits in the tax code that require you to have money to invest in the first place. For example, contrary to the hucksters on late-night infomercials, you need money to purchase real estate, which offers many tax benefits. See Part 5. And because taxes are probably your largest or second biggest expenditure, a budget that overlooks tax reduction strategies is likely doomed to fail. Unless you have wealthy, benevolent relatives, you may be stuck with a lifetime of working if you can't save money. Retirement accounts. Taking advantage of retirement accounts can mean tens, perhaps even hundreds of thousands more dollars in your pocket come retirement time. Who says there are no free lunches? Check out Chapter 4. Investing. Merely choosing investments that generate healthy rates of return isn't enough. What matters is not what you make, but what you keep after paying taxes. Understand and capitalize on the many tax breaks available to investors in stocks, bonds, mutual funds, exchange-traded funds, real estate, and your own business. See Part 4 for details on the latter. Protecting your assets. Some of your insurance decisions also affect the taxes you pay. You'd think that after a lifetime of tax payments, your heirs would be left alone when you pass on to the great beyond. Wishful thinking. Estate planning can significantly reduce the taxes to be siphoned off from your estate. Peruse Chapter 6 to find out more about estate planning. Taxes infiltrate many areas of your personal finances. Some people make important financial decisions without considering taxes and other important variables. Conversely, in an obsession to minimize or avoid taxes, other people make decisions that are counterproductive to achieving their long-term personal and financial goals. Although this chapter shows you that taxes are an important component to factor into your major financial decisions, taxes should not drive or dictate the decisions you make. Taxing mistakes. Even if some parts of the tax system are hopelessly and unreasonably complicated, there's no reason why you can't learn from the mistakes of others to save yourself some money. With this goal in mind, this section details common tax blunders that people make when it comes to managing their money. Seeking advice after a major decision. Too many people come across information and hire help after making a decision, even though seeking preventive help ahead of time generally is wiser and less costly. Before making any major financial decisions, educate yourself. This book can help answer many of your questions. Tip: if you're going to hire a tax advisor to give advice, do so before making your decisions. The wrong move when selling a piece of real estate or taking money from a retirement account can cost you thousands of dollars in taxes. Failing to withhold enough taxes. Warning: if you're self-employed or in significant taxable income from investments outside retirement accounts, you need to be making estimated quarterly tax payments. Likewise, if during the year you sell an investment at a profit, you may need to make a higher quarterly tax payment. Not having a human resources department to withhold taxes from their pay as they earn it, some self-employed people dig themselves into a perpetual tax hole by failing to submit estimated quarterly tax payments. They get behind in their tax payments during their first year of self-employment and thereafter are always playing catch-up. People often don't discover that they should have paid more taxes during the year until after they complete their returns in the spring, or get penalty notices from the IRS and their states. Then they have to come up with sizable sums all at once. Don't be a should-have victim. To make quarterly tax payments, complete IRS Form 1040-ES, Estimated Tax for Individuals. This form and accompanying instructions explain how to calculate quarterly tax payments, which you can do through the IRS website or by mailing payment coupons with your check. Tip: although I and the IRS want you to keep your taxes current during the year, I don't want you to overpay. Some people have too much tax withheld during the year, and this overpayment can go on year after year. Although it may feel good to get a sizable refund check every spring, why should you loan your money to the government interest-free? When you work for an employer, you can complete a new W-4 to adjust your withholding. Turn the completed W-4 into your employer. When you're self-employed, complete Form 1040-ES. If you know that you'd otherwise spend the extra tax money that you're currently sending to the IRS, then this forced saving strategy may have some value. But you can find other, better ways to make yourself save. You can set up all sorts of investments, such as mutual funds, see Chapter 9, to be funded by automatic contributions from your paychecks or from a bank or investment account. Of course, if you happen to prefer to loan the IRS money interest-free, go right ahead. Overlooking legitimate deductions. Some taxpayers miss out on perfectly legal tax deductions because they just don't know about them. Ignorance is not bliss. When it comes to your income taxes, it's costly. If you aren't going to take the time to discover the legitimate deductions available to you, you bought this book, so why not read the relevant parts of it? Spring for the cost of a competent tax advisor at least once. Fearing an audit, some taxpayers, and even some tax preparers, avoid taking deductions that they have every right to take. Unless you have something to hide, such behavior is foolish and costly. Remember that a certain number of returns are randomly audited every year, so even when you don't take every deduction to which you're legally entitled, you may nevertheless get audited. An hour or so with the IRS is not as bad as you may think. It may be worth the risk of claiming all the tax breaks to which you're entitled, especially when you consider the amounts you can save over the years. Passing up retirement accounts. All the tax deductions and tax deferrals that come with accounts such as 401ks, 403bs, SEP IRAs, and IRAs were put in the tax code to encourage you to save for retirement. So why not take advantage of the benefits? You probably have your reasons or excuses, but most excuses for missing out on this strategy just don't make good financial sense. People often underfund retirement accounts because they spend too much and because retirement seems so far away. Many people also mistakenly believe that retirement account money is totally inaccessible until they're old enough to qualify for senior discounts. See Chapter 4 to find out all about retirement accounts and why you should probably fund them. Ignoring tax considerations when investing. Suppose that you want to unload some stock so that you can buy a new car. You sell an investment at a significant profit and feel good about your financial genius. But come tax time, you may feel differently. Remember, don't forget to consider the taxes due on profits from the sale of investments, except those in retirement accounts, when making decisions about what you sell and when you sell it. Your tax situation should also factor into what you invest outside retirement accounts. When you're in a relatively high tax bracket, you probably don't want investments that pay much in taxable distributions, such as taxable interest, which only add to your tax burden. See Part 3 for details on the tax considerations of investing and which investments are tax-friendly for your situation. Not buying a home. In the long run, owning a home should cost you less than renting. And because mortgage interest and property taxes may be partially deductible, the government in effect subsidizes the cost of home ownership. Even if the government didn't help you with tax benefits when buying and owning a home, you'd still be better off owning throughout your adult life. If you rent instead, all your housing expenses are exposed to inflation, unless you have a great rent control deal. So owning your own abode makes good financial and tax sense. And don't let the lack of money for a down payment stand in your way. Methods exist for buying real estate with little upfront money. See Part 5 to find out about real estate and taxes. Allowing your political views to distort your decision-making. Some folks have strong political views. I'm sure you have your reasons for why you believe and advocate what you do, and I'm not here to talk you out of that. But I will tell you that I've seen plenty of people make poor financial decisions, especially with investments, because their political concerns get in the way. Consider some examples. In late 2008, President Barack Obama was elected, and as being a pretty liberal guy, freaked out some conservatives, especially because the Democrats then controlled the presidency and the House and Senate. Pundits, especially those of the conservative persuasion, warned that the economy, already in tough shape when he took office, was going to be in tatters for years to come, as Obama would raise taxes and investments would do poorly. While economic growth wasn't rapid, the economy performed pretty well in 2009 and the following years, and stock prices bounced back nicely, as they generally do after a major bear market. In late 2016, President Donald Trump was elected, and he, as being an outspoken, inexperienced politician who espoused conservative policies, freaked out some liberals, especially with Republicans in control of the House, Senate, and presidency. Prognosticators, especially on the left politically, opined that Trump would cause the economy and stock market to crash and burn, as his restless tax-cutting policies would explode the deficit and cause myriad other problems. That didn't happen, as economic growth accelerated and stock prices did quite well. And while the COVID-19 pandemic and mandated government economic shutdowns upset things for some months in early 2020, the economy and stock prices quickly bounced back. Tip: there's a simple moral to the stories here. To be a successful investor and make sound financial decisions, try to leave your political beliefs out of it and be unemotional. Extreme changes rarely occur even when one-party rule occurs for a couple of years in Washington, D.C. It's often soon replaced by divided government, which leads to more incremental change and eventually a switch in power back to the current out-of-power party. Ignoring the financial aid tax system. Warning: the college financial aid system in this country assumes that the money you save outside tax-sheltered retirement accounts is available to pay educational expenses. As a result, families who save money outside instead of inside retirement accounts may qualify for far less financial aid than they otherwise would. Financial aid is actually a misnomer, because what colleges and universities are doing is charging a different price to different families after analyzing their finances. So when a college appears to be giving you money, what they're actually doing is reducing their inflated prices to a more reasonable level. If you're affluent and have done a good job saving and investing money, colleges are generally going to charge you more. So in addition to normal income taxes, an extra financial aid tax is effectively exacted. To find out the best ways to save and invest for educational costs, see Chapter 5. Neglecting the timing of events you can control. The amount of tax you pay on certain transactions can vary depending on the timing of events. If you're nearing retirement, for example, you may soon be in a lower tax bracket. To the extent possible, you should consider delaying and avoid claiming investment income until your overall income level drops, and you need to take as many deductions or losses as you can now while your income is still high. Following are two tax-reducing strategies: income shifting and bunching or shifting deductions that you may be able to put to good use when you can control the timing of either your income or deductions. Shifting income. Suppose that your employer tells you in late December that you're eligible for a bonus. You find out that you have the option of receiving your bonus in either December or January. Ask your payroll and benefits department if this is an option. Looking ahead, if you're pretty certain that you're going to be in a higher tax bracket next year, request to receive your bonus in December. See Chapter 1 to find out about your tax bracket. Or suppose that you run your own business and operate on a cash accounting basis and think that you'll be in a lower tax bracket next year. Perhaps business has slowed of late, or you plan to take time off to be with a newborn or take an extended trip. You can send out some invoices later in the year so that your customers won't pay you until January, which falls in the next tax year. Bunching or shifting deductions. When the total of your itemized deductions on Schedule A is lower than the standard deduction, you need to take the standard deduction. This itemized deduction total is worth checking each year because you may have more deductions in some years than others, and you may occasionally be able to itemize. When you can control the timing of payment of particular expenses that are eligible for itemizing, you can shift or bunch more of them into select years when you're more likely to have enough deductions to take advantage of itemizing. Suppose that because you don't have many itemized deductions this year, you use the standard deduction. Late in the year, however, you feel certain that you'll itemize next year because you plan to buy a home and will therefore be able to claim significant mortgage interest and some property tax deductions. It makes sense then to shift and bunch as many deductible expenses as possible into next year. For example, if you're getting ready to make a tax-deductible donation of old clothes and household goods to charity, wait until January to do so. In any tax year that you're sure you won't have enough deductions to be able to itemize, shift as many itemizable expenses as you can into the next year. Warning: be careful when using your credit card to pay expenses. These expenses must be recognized for tax purposes in the year in which the charge was made on the card, and not when you actually pay the credit card bill. Not using tax advisors effectively. If your financial situation is complicated, going it alone and relying only on the IRS instructions to figure your taxes usually is a mistake. Many people find the IRS publications tedious and not geared toward highlighting opportunities for tax reductions. Instead, you can start by reading the relevant sections of this book. You can figure out taxes for yourself, or you can hire a tax advisor to figure them out for you. Doing nothing isn't an advisable option. Tip: when you're overwhelmed by the complexity of particular financial decisions, get advice from tax and financial advisors who sell their time and nothing else. Protect yourself by checking references and clarifying what advice, analysis, and recommendations the advisor will provide for the fee charged. If your tax situation is complicated, you'll probably more than recoup a preparer's fee as long as you take the time to hire a good advisor. Tip: remember that using a tax advisor is most beneficial when you face new tax questions or problems. If your tax situation remains complicated, or if you know that you do a worse job on your own, by all means keep using a tax preparer. But don't pay a big fee year after year to a tax advisor who simply plugs your numbers into the tax forms. If your situation is unchanging or isn't that complicated, consider hiring and paying someone to figure out your taxes one time. After that, go ahead and try completing your own tax return. Comprehending the causes of bad tax decisions. When bad things happen, it's usually for a variety of reasons. And so it is with making financial blunders that cause you to pay more tax dollars. The following sections describe some common culprits that may keep you from making tax-wise financial maneuvers and what you can do about them. Financial planners and brokers' advice. Wanting to hire a financial advisor to help you make better financial decisions is a logical inclination, especially if you're a time-starved person. But when you pick a poor planner, or someone who isn't a financial planner, but rather a salesperson in disguise, watch out. Warning. Unfortunately, many people calling themselves financial planners, financial consultants, or financial advisors actually work on commission, which creates enormous conflicts of interest with providing unbiased and objective financial advice. Brokers and commission-based financial planners, who are also therefore brokers, structure their advice around selling you investment and other financial products that provide them with commissions. As a result, they tend to take a narrow view of your finances and frequently ignore the tax and other consequences of financial moves. Or they may pitch the supposed tax benefits of an investment they're eager to sell you as a reason for you to buy it. It may provide a tax benefit for someone, but not necessarily for you in your specific situation. The few planners who work on a fee basis primarily provide money management services and typically charge about 1% per year of the money they manage. Fee-based planners have their own conflicts of interest because, all things being equal, they want you to hire them to manage your money. Therefore, they can't objectively help you decide whether you should pay off your mortgage and other debts, invest in real estate or a small business, or invest more in your employer's retirement plan. In short, they have a bias against financial strategies that take your investment money out of their hands. Warning. Be especially leery of planners, brokers, and money-managing planners who lobby you to sell investments that you've held for a while and that show a profit. If you sell these investments, you may have a hefty tax burden. See Part 3 for more insight on how to make these important investing decisions. Advertising. Another reason you may make tax missteps in managing your personal finances is advertising. Although reputable financial firms with terrific products advertise, the firms that spend the most on advertising often are the ones with inferior offerings. Being bombarded with ads whenever you listened to the radio, watched television, or read magazines and newspapers was bad enough. But now, email boxes, websites, and social media platforms are stuffed full of spam and promos, too. Warning. Responding to ads usually is a bad financial move. Regardless of whether the product being pitched is good, bad, or so-so, because the company placing the ad typically is trying to motivate you to buy a specific product. The company doesn't care about your financial alternatives, whether its product fits with your tax situation, and so on. Many ads try to catch your attention with the supposed tax savings that their products generate. Advice from websites and publications. You read an article that recommends some investments. Tired of not taking charge and making financial decisions, you get on the phone, call an investment company, and before you know it, you've invested. You feel a sense of relief and accomplishment. You've done something. Come tax time, you get all these confusing statements detailing dividends and capital gains that you must report on your tax return. Now you see that these investment strategies generate all sorts of taxable distributions that add to your tax burden. And you may be saddled with additional tax forms to complete by April 15th. You wish you had known. Warning. Articles on websites and in magazines, newspapers, newsletters, and so forth can help you stay informed, but they also can cause you to make ill-advised financial moves that overlook tax consequences. Article writers have limited time and space and often don't consider the big picture or ways their advice can be misunderstood or misused. Even worse is that too many writers don't know the tax consequences of what they're writing about. Overspending. Far too many tax guides go on and on and on, talking about this tax break and that tax break. The problem is that to take advantage of many of the best tax breaks, you need to have money to invest. When you spend all that you earn, you miss out on many terrific tax benefits that I tell you about in this book. And the more you spend, the more taxes you pay, both on your income and on the purchases you make through sales taxes. Just like losing weight, spending less sounds good, but most people have a hard time budgeting their finances and spending less than they earn. Perhaps you already know where the fat is in your spending. If you don't, figuring out where all your monthly income is going is a real eye-opener. The task takes some detective work, looking through your credit card statements and your checkbook register to track your purchases and categorize your spending. Financial illiteracy. Lack of personal finance education is at the root of most money blunders. You may not understand the tax system and how to manage your finances because you were never taught how to manage them growing up in high school or college. Financial illiteracy is a widespread problem not just among the poor and undereducated. Most people don't plan ahead and educate themselves with their financial goals in mind. People react, or worse, do nothing at all. You may dream, for example, about retiring and never having to work again. Or perhaps you hope that someday you can own a house, or even a vacation home in the country or by the shore. You need to understand how to plan your finances so you can accomplish your financial goals. You also need to understand how the tax system works and how to navigate within it to work toward your objectives. Tip: if you need more help with important personal financial issues, pick up a copy of the latest edition of my Personal Finance for Dummies, Wiley. Chapter 4. Maximizing Your Retirement Account. In this chapter, understanding the advantages and potential pitfalls of retirement accounts, comparing the different types and rules of retirement accounts, understanding transfers and withdrawals. Saving and investing through retirement accounts is one of the simplest yet most powerful methods to reduce your tax burden. Understanding the myriad account options and rules isn't simple, but I do my best at explaining them in this chapter. Unfortunately, most people can't take advantage of these plans because they spend too much of what they make. So not only do they have less savings, but they also have higher income taxes, a double whammy. And don't forget, the more you spend, the more sales tax you pay on purchases. To be able to best take advantage of the tax savings that come with retirement savings plans, you should spend less than you earn. Only then can you afford to contribute to these plans. I'll walk you through these different retirement accounts and their tax implications in this chapter so you can make well-informed decisions for your retirement savings. Funding your retirement accounts. Retirement may seem like the distant future to young folks. It's often not until middle age that warning bells start stimulating thoughts about what money they'll live on in their golden years. The single biggest mistake people at all income levels make with retirement accounts is not taking advantage of them. When you're in your 20s and 30s, and for some individuals in their 40s and 50s, spending and living for today and postponing saving for the future seems a whole lot more fun than saving for retirement. But assuming that you don't want to work your entire life, the sooner you start saving, the less painful it is each year because your contributions have more years to grow. Each decade that you delay contributing approximately doubles the percentage of your earnings that you need to save to meet your goals. For example, if saving 5% per year in your early 20s gets you to your retirement goal, waiting until your 30s may mean stocking away 10%, waiting until your 40s, 20%. It gets ugly beyond that. So the longer you wait, the more you'll have to save, and therefore, the less that will be left over for spending. As a result, you may not meet your goal, and your golden years may be more restrictive than you hoped. I use this simple lesson to emphasize the importance of considering now the future benefits you achieve by saving and investing in some type of retirement account. Remember, saving money is difficult for most people. Don't make a tough job impossible by forsaking the tax benefits that come from investing through retirement accounts. Warning: starting your savings sooner. Many investors make a common mistake. by neglecting to take advantage of retirement accounts because of their enthusiasm to spend or invest in non-retirement accounts. Not investing in tax-sheltered retirement accounts can cost you hundreds, perhaps thousands of dollars per year in lost tax savings. Add up that loss over the many years that you work and save, and you'll find that not taking advantage of these tax reduction accounts can easily cost you tens of thousands to hundreds of thousands of dollars in the long term. Ouch! To take advantage of retirement savings plans and the tax savings that accompany them, you must first spend less than you earn. Only then can you afford to contribute to these retirement savings plans, unless you already happen to have a stash of cash from previous savings or inheritance. Remember, the sooner you start to save, the less painful it is each year to save enough to reach your goals. Why? Because your contributions have more years to compound and be sheltered from taxation. As I explained in the preceding section, each decade you delay saving approximately doubles the percentage of your earnings that you need to save to meet your goals. If you enjoy spending money and living for today, you should be more motivated to start saving sooner. The longer that you wait to save, the more you ultimately need to save, and therefore, the less you can spend today. Choosing retirement account investments. When you establish a retirement account, you may not realize that the retirement account is simply a shell or shield that keeps the federal, state, and local governments from taxing your investment earnings each year. You still must choose which investments you want to hold inside your retirement account shell. You may invest money for your IRA or self-employed plan retirement account, for example, your SEP IRA, in stocks, bonds, mutual funds, exchange-traded funds, and even bank accounts. Mutual funds, offered in most employer-based plans, and exchange-traded funds are an ideal choice because they offer diversification and professional management. After you decide which financial institution you want to invest through, simply obtain and complete the appropriate paperwork for establishing the specific type of account you want. Don't go overboard. Over the years, I've seen some clients over-contribute to retirement accounts. I don't literally mean that these well-intentioned souls broke the contribution limit rules in a given tax year. I'm talking about unusual situations where people have contributed more to their retirement accounts than what makes good financial and tax sense. For example, it may not make sense for a taxpayer who is temporarily in a very low tax bracket or owing no tax at all to contribute to retirement accounts, especially those offering an upfront tax break. Roth accounts are an exception because their tax breaks are ongoing and at withdrawal, not upfront. Ditto the person who has a large estate already and has piles inside retirement accounts that can get walloped by estate and income taxes upon their passing. Few people, of course, have this perhaps enviable problem. When in doubt, and if you have reason to believe you should scale back on retirement account contributions, consult with a competent financial/tax advisor who works for an hourly fee and doesn't sell products or manage money. Please see the latest edition of my Personal Finance for Dummies, Wiley, for more details. Gaining tax benefits. Retirement accounts should be called tax reduction accounts. If they were, more people would be motivated to contribute to them. Contributions to these plans are generally deductible for both your federal and state income taxes. Suppose that you pay about 30% between federal and state income taxes on your last dollars of income. With most of the retirement accounts that I describe in this chapter, you can save yourself about $300 in taxes for every $1,000 that you contribute in the year that you make your contribution. Tip: check with your employer's benefits department because some organizations match a portion of employee contributions. Be sure to partake of this free matching money by contributing to your retirement accounts. After your money is in a retirement account, any interest, dividends, and appreciation grow inside the account without taxation. With most retirement accounts, you defer taxes on all the accumulating gains and profits until you withdraw your money down the road which you can do without penalty after age 59 and a half. In the meantime, more of your money works for you over a long period of time. In some cases, such as with the Roth IRAs described later in this chapter, withdrawals are tax-free too. Special tax credit for lower income earners. In addition to the upfront tax break you get from contributing to many retirement accounts, lower income earners may receive tax credits worth up to 50% on the first $2,000 of retirement account contributions. Like employer matching contributions, this tax credit amounts to free money, in this case from the government, so you should take advantage. As you can see in Table 4-1, this retirement account contribution tax credit phases out quickly for higher income earners, and no such credit is available to single taxpayers with adjusted gross incomes, AGIs, above $38,250, heads of household with AGIs above $57,375, and married couples filing jointly with AGIs above $76,500. Note, this credit isn't available to taxpayers who are claimed as dependents on someone else's tax return or who are under the age of 18 or full-time students. Table 4-1. 2024 tax credit for the first $2,000 in retirement plan contributions. Single taxpayers AGI, $0 to $23,000, head of household AGI, $0 to $34,500, married couples filing jointly AGI, $0 to $46,000, tax credit, 50%. Single taxpayers AGI, $23,000 to $25,000, head of household AGI, $34,500 to $37,500, married couples filing jointly AGI, $46,000 to $50,000, tax credit, 20%. Single taxpayers AGI, $25,000 to $38,250, head of household AGI, $37,500 to $57,375, married couples filing jointly AGI, $50,000 to $76,500, tax credit, 10%. Tax-deferred compounding of investment earnings. After money is placed in a retirement account, any interest, dividends, and appreciation add to the amount in the account without being taxed. You get to defer taxes on all the accumulating gains and profits until you withdraw the money, presumably in retirement. Thus, more money is working for you over a longer period of time. Your retirement tax rate need not be less than your tax rate during your working years for you to come out ahead by contributing to retirement accounts. In fact, because you defer paying tax and have more money compounding over more years, you can end up with more money in retirement by saving inside a retirement account, even if your retirement tax rate is higher than it is now. The tax rate on long-term capital gains, investments held more than 1 year, and stock dividends, see Chapter 7, is significantly lower than the rate on ordinary income. Watch out, though. The current rates may increase, at least for some higher income taxpayers. So keep an eye on Washington and subsequent editions of this book to keep absolutely up to date. Remember, you may get an added bonus from deferring taxes on your retirement account assets if you're in a lower tax bracket when you withdraw the money. You may well be in a lower tax bracket in retirement because most people have less income when they're not working. Tip: when you're near retirement and already have money in a tax-sheltered type of retirement account, for example at your employer, by all means continue to keep it in a tax-favored account if you leave. You can accomplish this goal by rolling the money over into an IRA account. If your employer offers good investment options in a retirement plan and allows you to leave your money in the plan after your departure, consider that option too. Naming the types of retirement accounts. When you earn employment income or receive alimony, you have the option of putting money away in a retirement account that compounds without taxation until you withdraw the money. In most cases, your contributions are tax-deductible. The following sections discuss IRS-approved retirement accounts and explain how to determine whether you're eligible for them and some other nitpicky but important rules. Employer-sponsored plans. You should be thankful that your employer values your future enough to offer these benefits, and grateful that your employer has gone to the trouble of doing the legwork of setting up the plan and, in most cases, selecting investment options. If you were self-employed, you'd have to hassle with establishing your own plan and choosing investment options. All you have to do with an employer plan is save enough to invest and allocate your contributions among the generally few investments offered. 401k plans. For-profit companies generally offer 401k plans. The silly name comes from the section of the tax code that establishes and regulates these plans. A 401k generally allows you to save up to $23,000 for tax year 2024. Your employer's plan may have lower contribution limits, though, if employees don't save enough in the company's 401k plan. Your contributions to a 401k generally are excluded from your reported income and thus are free from federal and, in some cases, state income taxes, but not from Social Security and Medicare taxes, and from some other state employment taxes. Older workers, those at least age 50, are able to put away even more, up to $7,500 more per year than their younger counterparts. The annual contribution limit on 401k plans and the additional amounts allowed for older workers rise in $500 increments with inflation. Some employers don't allow you to start contributing to their 401k plan until you've worked for them for a full year. Others allow you to start contributing right away. Some employers also match a portion of your contributions. They may, for example, match half of your first 6% of contributions. So in addition to saving a lot of taxes, you get a free bonus from the company. Check with your company's benefits department for your plan's details. Smaller companies, those with fewer than 100 employees, can consider offering 401k plans too. In the past, it was prohibitively expensive for smaller companies to administer a 401k plan. If your company is interested in this option, contact a mutual fund or discount brokerage organization such as T. Rowe Price, Vanguard, Schwab, or Fidelity. In some cases, your employer may need to work with a separate plan administrator in addition to one of these investment firms. 403b plans. Many nonprofit organizations offer 403b plans to their employees. State and local government employees may have 457 plans, and federal government workers have the Thrift Savings Plan, which are similar. As with a 401k, your contributions to these plans generally are federal and state tax deductible. 403b plans often are referred to as tax-sheltered annuities, the name for insurance company investments that satisfy the requirements for 403b plans. For the benefit of 403b retirement plan participants, no-load, commission-free mutual funds also can be used in 403b plans. Nonprofit employees generally are allowed to contribute up to 20% or $23,000 of their salaries, whichever is less. Employees who have 15 or more years of service may be allowed to contribute beyond the $23,000 limit. Ask your company's benefits department or the investment provider for the 403b plan or your tax advisor about eligibility requirements and details about your personal contribution limit. As with 401k plans, the contribution limit for workers age 50 and older in 2024 is $30,500. The annual contribution limit on 403b plans and the additional amounts allowed for older workers rise in $500 increments with inflation. After-tax 401k and 403b contributions. Some employer-based retirement plans allow for Roth after-tax contributions to both 401k and 403b plans. Like Roth IRA contributions, Roth 401k and Roth 403b contributions not only grow tax-deferred, but also allow for tax-free withdrawal of investment earnings. Generally speaking, you still will likely be better off making pre-tax retirement plan contributions before considering after-tax Roth contributions. Most people are best served taking the sure tax break than waiting many years for an unspecified tax break. However, you may consider these accounts if you're currently in a very low tax bracket or you're an older worker who already has a large amount saved in traditional pre-tax accounts. Please see my discussion in the section To Roth or Not to Roth later in this chapter for further information. Tip: if you work for a nonprofit or public sector organization that doesn't offer this benefit, request it. Nonprofit organizations have no excuse not to offer 403B plans to their employees. Unlike 401k plans, 403B plans have virtually no out-of-pocket setup expenses or ongoing accounting fees. The only requirement is that the organization must deduct the appropriate contribution from employees' paychecks and send the money to the investment company handling the 403B plan. If your employer doesn't know where to look for good 403B investment options, send them to Vanguard 877-859-5756, Fidelity 800-548-2363, or T. Rowe Price 800-492-7670, all of which offer solid mutual funds and 403B plans. Simple plans. Employers and small businesses have yet another retirement plan option known as the Simple IRA. Simple stands for Savings Incentive Match Plans for Employees. Relative to 401k plans, Simple plans make it somewhat easier for employers to reduce their costs thanks to easier reporting requirements and fewer administrative hassles. However, employers may escape the non-discrimination testing requirements, one of the more tedious aspects of maintaining a 401k plan, by adhering to the matching and contribution rules of a Simple plan, as described later in this section. The contribution limit for Simple plans is $16,000 for tax year 2024 for younger workers, $19,500 for those age 50 and older. Annual contribution limits increase in increments of $500 with inflation. Employers must make small contributions on behalf of employees. Employers can either match dollar for dollar the first 3% the employee contributes, or contribute 2% of pay for everyone whose wages exceed $5,000. Interestingly, if the employer chooses the first option, the employer has an incentive not to educate employees about the value of contributing to the plan, because the more employees contribute, the more it costs the employer. And unlike a 401k plan, greater employee contributions don't enable higher-paid employees to contribute more. Self-employed plans. Although setting up a self-employed plan means some legwork for you as a business owner, you can select and design a plan that meets your needs. You can actually do a better job than many companies do. Often the people establishing a retirement plan don't do enough homework, or they let some salesperson sweet-talk them into high-expense, for the employees, that is, investments. Your trouble will be rewarded. Self-employment retirement plans generally enable you to sock away more money on a tax-deductible basis than most employers' plans do. Warning: if you have employees, you're required to make contributions comparable to the company owners, as a percentage of salary, on their behalf under these plans. Some part-time employees, those working fewer than 500 to 1,000 hours per year, and newer employees, less than a few years of service, may be excluded. Not all small business owners know about this requirement, or they choose to ignore it, and they set up plans for themselves but fail to cover their employees. The danger is that the IRS and state tax authorities may, in the event of an audit, hit you with big penalties and disqualify your prior contributions if you have neglected to make contributions for eligible employees. Because self-employed people and small businesses get their taxes audited at a relatively high rate, messing up in this area is dangerous. The IRS also has a program to audit small pension plans. Tip: don't avoid setting up your retirement savings plan for your business just because you have employees and you don't want to make contributions on their behalf. In the long run, you can build the contributions you make for your employees into their total compensation package, which includes salary and other benefits like health insurance. Making retirement contributions need not increase your personnel costs. The secure Setting Every Community Up for Retirement Enhancement Act of 2019 provides for up to $5,000 in tax credits for eligible small business owners when starting a retirement plan. This credit applies to new 401k profit sharing, SEP, and simple plans for small employers with up to 100 employees. To get the most from your contributions as an employer, consider the following. Educate your employees about the value of retirement savings plans. You want them to understand how to save for the future and to value and appreciate your investment. If you have more than 20 or so employees, consider offering a 401k or simple plan which allows employees to contribute money from their paychecks. SEP IRAs. Simplified Employee Pension Individual Retirement Account (SEP IRA) plans require little paperwork to set up. Each year, you decide the amount you want to contribute to your SEP IRA. No minimums exist. Your contributions to a SEP IRA are deducted from your taxable income, saving you big time on federal and usually state taxes. As with other retirement plans, your money compounds without taxation until withdrawal. SEP IRAs allow you to sock away about 20% of your self-employment income, business revenue minus expenses, up to a maximum of $69,000 for tax year 2024. Self-employed I-401k plans. Another alternative is the self-employed or individual 401k plan, which offers traditional contribution and Roth after-tax contribution features. This plan type is only for sole proprietors and their working spouses in the business, and partnerships with no eligible employees. The pre-tax contribution limits are the same as SEP IRA. The after-tax limits are the same as the employee 401k limits, up to $23,000, except those age 50 or older can make catch-up contributions of up to $7,500 more. Defined benefit plans. These plans are for people who are able and willing to put away more than the SEP IRA contribution limit of $69,000 per year. Of course, only a small percentage of people can afford to do so. Consistently high-income earners who want to save more than $69,000 per year in a retirement account should consider these plans. Technical stuff. If you're interested in defined benefit plans, you need to hire an actuary to calculate how much you can contribute to such a plan. Individual retirement accounts, IRAs. A final retirement account option is an individual retirement account, IRA. Because your IRA contributions may not be tax-deductible, contributing to an IRA generally makes sense only after you've exhausted contributing to other retirement accounts, such as the employer and self-employed-based plans discussed earlier, which allow for tax-deductible contributions. The following sections discuss your IRA options. Regular IRAs. The annual contribution limit for IRAs, both regular and the newer Roth IRAs, see the section later in this chapter, Non-Deductible IRA Contributions, is $7,000. People age 50 and older may contribute even more, an extra $1,000 per year for a total of $8,000. Your contributions to a regular IRA may or may not be tax-deductible if you are covered by a retirement plan at work. For tax year 2024, if you're single and your adjusted gross income, AGI, is $77,000 or less for the year, you can deduct your IRA contribution in full. If you're married and file your taxes jointly, you're entitled to a full IRA deduction if your AGI is $123,000 per year or less. Note, these AGI limits will increase in future tax years. More details in a moment. The only way to know for certain whether you're an active participant in a retirement plan is to look at your W-2 form, that small 4 by 8.5-inch document your employer sends you early in the year to file with your tax returns. An X mark in a little box in Section 13 on the W-2 form indicates that you're an active participant in an employer retirement plan. Understanding mandatory distribution rules. If you're self-employed or retired from a company, the year you turn 73, effective in 2023, you have to make some important decisions about how the money will come out of your regular IRA. This policy isn't applicable to Roth IRAs. The first choice: whether you receive yearly distributions based on your life expectancy or based on the joint life expectancies of you and your beneficiary. If your aim is to take out as little as possible, you'll want to use a joint life expectancy. That choice will stretch out the distributions over a longer period. Next, you have to decide how you want your life expectancy to be calculated. Sometimes tax law changes actually make things simpler. You'll be happy to know that changes over the years to IRS regulations make required minimum distribution calculations easier. Under the prior laws, retirees had several confusing methods for calculating their mandated retirement account withdrawal amounts. With the new regulations, seniors can generally take their retirement account balances and divide that by a number from an IRS life expectancy table. Investment companies typically can provide you with this number as well. Another benefit of these new rules is that the newer tables generally produce lower required distributions and, therefore, a greater ability to preserve the account tax-free than was possible under the old regulations. Technical stuff. In some cases, you may see that the box is checked on your W-2 form indicating your active participation in a retirement plan when you haven't contributed any of your paycheck into a retirement plan. How can this be? Well, employers offer additional retirement plans outside those you contribute to from your paycheck. You're considered an active participant in a defined benefit plan, such as a traditional pension plan, as long as you're eligible to participate in the plan, even if you didn't make a required contribution, didn't perform the minimum service needed to accrue a benefit for the year, or never actively said you wanted to participate in the plan. Should you convert your regular IRA to a Roth IRA? If the Roth IRA's tax-free withdrawals of accumulated earnings appeal to you, you may be interested in knowing that the tax laws allow taxpayers to transfer money from a regular IRA to a Roth IRA without having to pay any early withdrawal penalties. Whether you'll come out ahead in the long run by doing this conversion depends largely on your time horizon and retirement tax bracket. The younger you are, the higher the tax bracket you think that you'll be in when you retire, and the smaller the account you're thinking of converting, the more such a conversion makes sense. On the other hand, if you drop into a lower tax bracket in retirement, as many retirees do, you're probably better off keeping the money in a standard IRA account. For assistance with crunching numbers to see whether a conversion makes financial sense, visit fidelity.com/calculators-tools/Roth-conversion-calculator/. Of course, if you can't afford to pay the current income tax you'll owe on the conversion, don't convert. And again, remember that a future Congress may reverse some of the benefits of the Roth IRA. Thus, I generally don't advise many people to convert a regular IRA into a Roth IRA. For tax year 2024, if you're a single income earner with an AGI above $77,000 but below $87,000, or married filing jointly with an AGI above $123,000 but below $143,000, you're eligible for a partial IRA deduction, even if you're an active participant. If you're married filing a separate return from your spouse, your ability to deduct your IRA contribution disappears at $10,000 of AGI. The size of the IRA deduction that you may claim depends on where you fall in the income range. For example, a single income earner at $82,000 is entitled to half of the full IRA deduction because their income falls halfway between $77,000 and $87,000. Non-deductible IRA contributions. You can contribute to an IRA even if you can't deduct a portion or all of an IRA contribution because you're already covered by another retirement plan and you're a higher income earner. An IRA contribution that isn't tax-deductible is called, not surprisingly, a non-deductible IRA contribution. I've never accused the IRS of being creative. To make a non-deductible contribution, you have to have employment income during the year equal to at least the amount of your IRA contribution. The benefit of this type of contribution is that the money can still compound and grow without taxation. For a person who plans to leave contributions in the IRA for a long time, a decade or more, this tax-deferred compounding may make non-deductible contributions worthwhile. However, before you consider making a non-deductible IRA contribution, be sure to read about the newer Roth IRAs in the next section that may offer better benefits for your situation. If you end up making a non-deductible IRA contribution, you may wonder how the IRS will know not to tax you again on those portions of IRA withdrawals, because you've already paid income tax on the non-deductible contribution, in retirement. Surprise, surprise! You must fill out another form, Form 8606, which you file each year with your tax return to track these non-deductible contributions. Roth IRAs. For years, some taxpayers and tax advisors, and book authors and financial counselors have complained about the rules and regulations on regular IRAs. The income limits that allowed for taking an IRA deduction were set too low, and many people who can't take a tax deduction on a contribution were unmotivated to make a non-deductible contribution, because earnings on the contribution still would be taxed upon withdrawal. Granted, the tax-deferred compounding of earnings is worth something, especially to younger people, but that's a more complicated benefit to understand and value. So, rather than addressing these concerns by changing regular IRAs, Congress decided to make things even more complicated by introducing another whole IRA known as the Roth IRA, named after the Senate Finance Committee chairman who championed these new accounts. Perhaps if congressional representatives couldn't name accounts after themselves, we may someday have real tax reform. Understanding the Roth IRA. The Roth IRA allows for up to a $7,000 annual contribution for couples with AGIs under $230,000 and for single taxpayers with AGIs under $146,000. Those individuals age 50 and older may contribute $8,000. The contribution limits are reduced for married taxpayers with AGIs above $230,000, $146,000 if single, and are eliminated for couples with AGIs above $240,000, $161,000 for singles. Although this newer IRA doesn't offer a tax deduction on funds contributed to it, it nevertheless offers benefits not provided by regular IRAs and some other retirement accounts. The distinguishing feature of the Roth IRA is that the earnings on your contributions aren't taxed upon withdrawal as long as you're at least age 59 and a half and have held the account for at least 5 years. An exception to the age 59 and a half rule is made for first-time homebuyers, who can withdraw up to $10,000 income tax-free from a Roth IRA in existence for at least 5 years to apply to the purchase of a principal residence. Another attractive feature of the Roth IRA, for those not needing to draw on all their retirement accounts in the earlier years of retirement, the Roth IRA, unlike a standard IRA, doesn't require distributions after the account holder passes age 73. To Roth or not to Roth? Before you race to contribute to a Roth IRA, keep in mind that the lack of taxation on withdrawn earnings is in no way guaranteed for the future. A future Congress can take that benefit away. If the government is running large deficits in future years, taxing Roth IRA withdrawals, especially for the more affluent, would increase tax revenue. On the other hand, retired voters vote, and members of the Congress that tap the short-term benefit of taxing too many of these accounts may face a voter backlash. Tip: consider contributing to a Roth IRA if you've exhausted your ability to contribute to tax-deductible retirement accounts and you aren't allowed a tax deduction for a regular IRA contribution because your AGI exceeds the regular IRA deductibility thresholds. If you find yourself in the fortunate situation that your high income disallows you from funding a Roth IRA, that would be a good reason to contribute to a non-deductible regular IRA after having maxed out your contributions to other tax-deductible retirement accounts. In that case, if your non-deductible IRA contribution is the only money you have in IRA accounts, consider converting that money into your Roth IRA. Under current tax law, which can change in the future, you are allowed to do this. Sorry, but you can't contribute $7,000 in the same tax year to both a regular IRA and a Roth IRA. The sum of your standard and Roth IRA contributions may not exceed $7,000 in a given year, $8,000 if you're over age 50. Penalty-free IRA withdrawals. Tip: except for a few situations having mostly to do with emergencies, such as a major illness and unemployment, tapping into an IRA account before age 59 and a half, called an early withdrawal, triggers a hefty 10% federal income tax penalty, in addition to whatever penalties your state charges. You're allowed to make a penalty-free early withdrawal from your IRA for some specific expenses. First-time homebuyers, defined as not having owned a home in the past 2 years, may withdraw up to $10,000. Amounts also may be withdrawn for qualified higher education costs, college expenses for a family member such as a child, spouse, the IRA holder, or grandchildren. You can also withdraw up to $5,000 per parent penalty-free from your retirement plan for a qualified birth or adoption distribution for the birth or adoption of a child. This new provision waives the normal 10% early withdrawal penalty and allows you to repay the withdrawn money as a rollover contribution. Early withdrawals from regular IRA accounts still are subject to regular income tax in the year of withdrawal. Withdrawals from a Roth IRA, discussed in the section Understanding the Roth IRA earlier in this chapter, can be both penalty-free and federal income tax-free as long as the Roth IRA account is at least 5 years old. Roth IRA accounts also are exempt from the normal retirement account requirement to begin taking minimum distributions at age 73 if you aren't working. Annuities. Annuities, like IRAs, allow your capital to grow and compound without taxation. You defer taxes until withdrawal. Annuities carry the same penalties for withdrawal prior to age 59 and a half as IRAs do. However, unlike all other retirement accounts except a Roth IRA, you aren't forced to begin withdrawals at age 73. You may leave the money in an annuity to compound tax-deferred for as many years as you desire. And unlike an IRA that has an annual contribution limit, you can deposit as much as you want in any year into an annuity, even $1 million if you have it. As with the so-called non-deductible IRA, you get no upfront tax deduction for your contributions. Thus, consider an annuity only after fully exhausting your other retirement account options. What exactly is an annuity? Well, annuities are peculiar investment products, contracts actually, that insurance companies back. If you, the annuity holder, investor, die during the so-called accumulation phase, that is, prior to receiving payments from the annuity, your designated beneficiary is guaranteed to receive the amount of your original investment. Tip: annuities carry higher fees than IRAs, which reduce your investment returns, because of the insurance that comes with them. So you should first make the maximum contribution that you can to an IRA, even if it isn't tax-deductible. Generally speaking, you should exhaust contributing to Roth accounts, as they are superior because investment earnings aren't taxed upon withdrawal. Also, consider annuities only if you plan to leave the money in the annuity for 15 years or more. The reasons are twofold. First, it typically takes that long for the tax-deferred compounding of your annuity investment to make up for the annuity's relatively higher expenses. Second, upon withdrawal, the earnings on an annuity are taxed at ordinary income tax rates, which are higher than the more favorable long-term capital gains and stock dividend tax rates. If you don't expect to keep your money invested for 15 to 20-plus years to make up for the annuity's higher ongoing fees and taxes on the back end, you should simply invest your money in tax-friendly investments in non-retirement accounts. See Part 3. Taxing retirement account decisions. In addition to knowing about the different types of retirement accounts available and the importance of using them, I know from my work with counseling clients that you're going to have other problems and questions. This section presents the sticky issues that you may be struggling with, along with my recommendations. Transferring existing retirement accounts. With employer-maintained retirement plans such as 401ks, you usually have limited investment options. Unless you are the employer or can convince the employer to change, you're stuck with what is offered. If your employer offers 4 mutual funds from the lots of fees and lousy performance fund company, for example, you can't transfer this money to another investment company. After you leave your employer, however, you generally have the option of leaving your money in the employer's plan or transferring it to an IRA at an investment company of your choice. The process of moving this money from an employer plan to investments of your choice is called a rollover. And you thought you weren't going to be reading anything fun today. Warning: when you roll money over from an employer-based retirement plan, don't take personal possession of the money. If your employer gives the money to you, the employer must withhold 20% of it for taxes. This situation creates a tax nightmare for you because you must then jump through more hoops when you file your return. You also should know that you need to come up with the extra 20% when you do the rollover, because you won't get the 20% back that your employer withheld in taxes until you file your tax return. If you can't come up with the 20%, you have to pay income tax and maybe even excise taxes on this money as a distribution. Yuck. I understand that some employers don't want the possible risk of issuing checks to myriad investment firms or advisors, especially smaller ones that they've never heard of. As a result, some employers will always issue a retirement plan check to you, mail it to your address on record, and include the investment company information you provide to them on the check. This is considered a direct rollover, and as such, the employer won't withhold the 20% federal tax. After you leave the company, you can move your money held in 401ks and many 403b plans, also known as tax-sheltered annuities, to nearly any major investment firm you please. Moving the money is pretty simple. If you can fill out a couple of short forms on the investment firm website or call to request forms to be sent to you and send them back in a postage-paid envelope, you can transfer an account. The investment firm to which you're transferring your account does the rest. Here's the lowdown on how to transfer retirement accounts without upsetting Uncle Sam or any other tax collector. 1. Decide to which investment firm you want to move the account. When investing in stocks and bonds, mutual funds are a great way to go. They offer diversification and professional management, and they're low cost. For more information on mutual funds, see Mutual Funds for Dummies by Eric Tyson, Wiley. 2. Visit the website or call the toll-free number of the firm you're transferring the money to and ask for an account application and asset transfer form for the type of account you're transferring. For example, SEP IRA, KEO, IRA, or 403b. The reason for allowing the new investment company to do the transfer for you is that the tax authorities impose huge penalties if you do a transfer incorrectly. Allowing the company to which you're transferring the money to do the transfer for you is far easier and safer. If the company screws up, good investment firms don't, the company is liable. 3. Complete and mail back the account application and asset transfer forms to your new investment company. Completing this paperwork for your new investment firm opens your new account and authorizes the transfer. If you have questions or problems, the firms to which you're transferring your account has armies of capable employees waiting to help you. Remember, these firms know that you're transferring your money to them, so they normally roll out the red carpet. Transferring your existing assets typically takes a month to complete. If the transfer isn't completed within a month, get in touch with your new investment firm to determine the problem. If your old company isn't cooperating, a call to a manager there may help to get the ball rolling. The unfortunate reality is that too many investment firms will cheerfully set up a new account to accept your money on a moment's notice, but they will drag their feet, sometimes for months, when it comes time to relinquish your money. If you need to light a fire under their behinds, tell a manager at the old firm that you're sending letters to the National Association of Securities Dealers, NASD, and the Securities and Exchange Commission, SEC, if they don't complete your transfer within the next week. Taking money out of retirement accounts. Someday, hopefully not until you retire, You'll need or want to start withdrawing and enjoying the money that you socked away in your retirement accounts. Some people, particularly those who are thrifty and good at saving money, also known by some as cheapskates and tightwads, have a hard time doing this. You saved and invested money in your retirement accounts to use at a future date. Perhaps you're in a pinch for cash, and the retirement account looks as tempting as a catered buffet meal after a day of fasting. Whatever the reason, here's what you need to consider before taking the money out of your retirement accounts. Some people start withdrawing funds from retirement accounts when they retire. This option may or may not be the best financial decision for you. Generally speaking, you're better off postponing drawing on retirement accounts until you need the money. The longer the money resides inside the retirement account, the longer it can compound and grow, tax-deferred. But don't wait if postponing means that you must scrimp and cut corners, especially if you have the money to use and enjoy. Remember, suppose that you retire at age 60, and in addition to money inside your retirement accounts, you have a bunch available outside. If you can, you're better off living off the money outside retirement accounts before you start tapping the retirement account money. If you aren't wealthy and have saved most of the money earmarked for your retirement inside retirement accounts, odds are you'll need and want to start drawing on your retirement account soon after you retire. By all means, do so. But have you figured out how long your nest egg will last and how much you can afford to withdraw? Most folks haven't. Take the time to figure how much of your money you can afford to draw on per year, even if you think that you have enough. Few people are wealthy enough to consider simply living off the investment income and never touching the principal, although more than a few people live like paupers so that they can do just that. Many good savers have a hard time spending and enjoying their money in retirement. If you know how much you can safely use, you may be able to loosen the purse strings. Warning: one danger of leaving your money to compound inside your retirement accounts for a long time after you're retired is that the IRS will require you to start making withdrawals the year you reach age 73. It's possible that because of your delay in taking the money out and the fact that it will have more time to compound and grow, you may need to withdraw a hefty chunk per year. This procedure can push you into higher tax brackets in those years that you're forced to make larger withdrawals. Tip: this forced distribution no longer applies to people who are working for a company, nor does it apply to money held in the newer Roth IRAs. See Roth IRAs earlier in this chapter. Self-employed individuals still have to take the distribution. If you want to plan how to withdraw money from your retirement accounts so that you meet your needs and minimize your taxes, consider hiring a tax advisor to help. If you have a great deal of money in retirement accounts and have the luxury of not needing the money until you're well into retirement, tax planning will likely be worth your time and money. Tip: if you've reached the magic age of 73 and are required to take an IRA distribution, but you don't need that additional income and you really don't want to pay any additional tax, you can now direct that your minimum distribution amount, or more if you're feeling generous, be paid directly to a qualified charity of your choice. The distribution qualifies as your annual required distribution, but the payment to charity excludes it from your adjusted gross income or your taxable income. Understanding early withdrawal penalties. One objection that some people have to contributing to retirement accounts is the early withdrawal penalties. Specifically, if you withdraw funds from retirement accounts before age 59 and a half, you not only have to pay income taxes on withdrawals, but you also pay early withdrawal penalties, 10% in federal plus applicable state charges. There's a 25% penalty for withdrawing from a simple plan within the first 2 years, which decreases to 10% thereafter. The penalties are in place for good reason, to discourage people from raiding retirement accounts. Remember, retirement accounts exist for just that reason, saving toward retirement. If you could easily tap these accounts without penalties, the money would be less likely to be there when you need it during retirement. If you have an emergency, such as catastrophic medical expenses or a disability, You may be able to take early withdrawals from retirement accounts without penalty. You may withdraw funds from particular retirement accounts free of penalties and, in some cases, even free of current income taxes for educational expenses or a home purchase. I spell out the specifics in the penalty-free IRA withdrawals section earlier in this chapter. What if you just run out of money because you lose your job? Although you can't bypass the penalties because of such circumstances, if you're earning so little that you need to tap your retirement account, you'll surely be in a low tax bracket. So even though you pay some penalties to withdraw retirement account money, the lower income taxes that you pay upon withdrawal, as compared to the taxes that you would have incurred when you earned the money originally, should make up for most or all of the penalty. Know also that if you get in a financial pinch while you're still employed, some company retirement plans allow you to borrow against a portion of your cash balance. Just be sure that you can repay such a loan. Otherwise, your loan becomes a withdrawal and triggers income taxes and penalties. Another strategy to meet a short-term financial emergency is to withdraw money from your IRA and return it within 60 days to avoid paying penalties. I don't generally recommend this maneuver because of the taxes and potential penalties invoked if you don't make the 60-day deadline. In the event that your only borrowing option right now is a credit card with a high interest rate, you should save 3 to 6 months' worth of living expenses in an accessible account before funding a retirement account to tide you over in case you lose your income. Money market mutual funds and bank savings accounts are useful vehicles for this purpose. Tip: you may be interested in knowing that if good fortune comes your way and you accumulate enough funds to retire early, you have a simple way around the pre-age 59.5 early withdrawal penalties. Suppose that at age 55 you retire and want to start living off some of the money you've stashed in retirement accounts. No problem. The U.S. tax laws allow you to start withdrawing money from your retirement accounts free of those nasty early withdrawal penalties. To qualify for this favorable treatment, you must commit to withdrawals for at least 5 continuous years, and the amount of the withdrawals must be at least the minimum required based on your life expectancy. Chapter 5: Children and Taxes. In this chapter, taking advantage of child tax breaks, figuring out taxes, financial aid, and educational expenses, understanding the kid tax system. Raising children involves many decisions and trade-offs. New parents are sometimes surprised at the financial and tax consequences of having kids. I include this chapter so that you can spend more time enjoying the first smile, first step, first word, and first high five, and save on your taxes. Raising kids. Although kids can cost a bunch of money, the expenses, or the thousands of diaper changes during the infant years, rarely deter people from wanting a family. And for good reason. Kids are wonderful, at least most of the time. They're the future. If you don't have kids, who do you think is going to fund your Social Security and Medicare benefits during your retirement years? Raising a family can be the financial equivalent of doing a triathlon. It can stretch and break the budgets of even those who consider themselves financially well off and on top of things. Taxes are an important factor in a number of kid-related issues. These sections include my take on some of the important tax issues that you may confront before conception and during the many years you're raising a child. Getting Junior a Social Security number. In order to claim tax benefits relating to your newborn, you need to get them a Social Security number. You also need a Social Security number for your child whenever you want to establish investment accounts in the child's name, although you may not want to after you understand the drawbacks of doing so, which I discuss later in this chapter. The IRS requires a Social Security number because people were inventing children, telling the IRS they'd just had twins when the closest they actually came to becoming parents was babysitting their best friend's kid one evening. If you need Form SS-5, application for a Social Security card, simply contact the Social Security Administration 800-772-1213, ssa.gov, and ask to have one mailed to you, or you can print it out yourself at ssa.gov/forms/ss-5.pdf. Taking advantage of child care tax goodies. In addition to the extra personal deduction that you can take with each new child and the tax savings that come with that deduction, you also need to be aware of the tax perks for child care and related expenditures that may save you thousands of dollars. Tip: Dependent care tax credit. When you hire child care assistance for your youngsters, you may be able to claim a tax credit on your annual return, which you claim on Form 2441. To be eligible for this credit, you and your spouse, if you're married, must work at least part-time, unless you're a full-time student or you're disabled. Your kids must be younger than the age of 13 or physically or mentally disabled. Because a credit is a dollar-for-dollar reduction in the taxes you owe, it can save you hundreds of tax dollars every year. And not only do you count child care expenses toward calculation of the tax credit, but you may also be able to count the cost of a housekeeper or even a cook if the expense benefits your kids. As the name of this credit suggests, expenses can be for taking care of dependents broadly, not just for your children under age 13. Caring for a physically or mentally ill spouse or others such as an elderly parent for at least half of the year counts too. The dependent care tax credit ranges from 20 to 35% of qualifying expenses of $3,000 for one qualifying person's expenses, with a $6,000 limit for two or more qualifying persons' expenses. The income threshold at which the credit begins to be reduced increases to $125,000 of adjusted gross income, AGI, and phases out completely at $438,000 of AGI. As I discuss later in this section, tax and other considerations influence your desire as a parent to work outside the home. Working at least part-time makes you eligible for this tax credit. If you choose to be a full-time mom or dad, unfortunately, you aren't eligible for the dependent care tax credit.